Hello everyone, hope you are all doing great. Today we are going to study a new chapter on consumption, real GDP and the multiplier. Welcome to this lecture. There are a lot of interesting topics that we are going to discuss in this chapter, and our learning objectives are to explain the determinants of consumption and saving in Keynesian model, identify the primary determinants of planned investment, describe how equilibrium real GDP is established in the Keynesian model, evaluate why autonomous changes in the total planned expenditure have a multiplier effect on the equilibrium real GDP, understand the relationship between the total planned expenditure and aggregate demand curve. At the end of recession in early 80s, 90s and 2000, business profit expectation improved, resulting in higher investment spending and real GDP, as well as higher ratio of investment expenditures to profits. At the end of late 2000 recession, however, the ratio failed to return to its previous level. During an 18-month period in the depth of Great Recession of late 2000, inflation adjusted spending on goods and services by US households declined by 2%. This drop in household expenditure followed on the heels of significant decline in the level of wealth and indebtedness of households. The consumption decrease also accompanied a fall in real disposable income, real GDP less real tax payment net of transfers earned by households. Now this topic will help you to understand why and how the 2% decline or decrease in the US consumption spending relates to the decline in the inflation adjusted household wealth and debts and to the fall of real disposable income. So why again there is improvement in the real GDP during the current decade has been sluggish, and how an understanding of the household real savings and real consumption can help you to evaluate the fluctuations in the nation's real GDP. If you see some data, the share of real GDP allocated to real consumption spending by household is about 60% in Germany, 66% in United Kingdom, 70% in United States and less than 45% in China. Let us now discuss about some of the assumptions in the Keynesian model. Remember, economists use assumptions because assumptions provide a way to simplify the economic process and make them easier to study and understand. An assumption allows the economist to break a complex process in order to develop a theory in the realm of understanding. So here there are few assumptions like the short run aggregate supply curve with the current range of real GDP is horizontal. The equilibrium level of real GDP is demand determined. And because the Keynesian assumption is of inflexible prices, inflation is not a concern in this analysis. Hence, the real values are identical to the nominal values. To simplify the income determination model, we assume that business pay no indirect taxes or the sales tax, business distribute all the profits to the shareholders, there is no depreciation, the economy is closed and no foreign trade. Now some of you may ask me question that why business will not pay tax, why there will be no depreciation if you are using the machine, equipment or various capital goods, Why there will be no foreign trade? Because in real world there will be foreign trade. But remember, these assumptions are only to explain the income determination model in theory. In practice, all these are, you know, happening. All these are happening, but the assumption helps, you know, to make or to explain the theory better, right? So here we are assuming four important things: that the business will not pay any kind of indirect taxes. There will be no depreciation. If you know, depreciation is charged on all the tangible assets like plant, equipment, furniture. All these are tangible assets. So for that, for, you know, depreciation, we are assuming there is no depreciation. So gross private investment equals the net investment, and the economy is closed, which means there is no foreign trade. So with all this controlled environment, we are going to explain the income determination model. Given all these simplifying assumptions, the real disposable income or the after tax real income will be equal to the real GDP minus net taxes. Taxes paid less transfer payment receipts. This is the picture of John Maynard Keynes. He was a British economist whose ideas was fundamentally, changed the theory and practice of macroeconomics and economic policies of the government. So based on his work, this Keynesian model are developed. My next point is definitions and relationships. Let us have another look at all those definitions. Now, if you have $1 and dollar of your disposable income, you can do two things. Either you can consume it or you can save it. Or we can say you can consume less and save more. Now, if you consume it, it is gone forever. You are spending it. If you are saving the entire dollar, however, you are able to consume it in the future, but you are also earning interest, because with that saved money, you are going to invest in the bank, in stock, in mutual fund, and various other alternatives. And this is one of the important distinction between the consumption and saving. Consumption is the act of using the income for the purchase of consumption goods. And we have discussed in the previous chapter what is consumption good. So consumption goods are those goods which are purchased by the households for immediate satisfaction. And that also includes not only goods but also services. Consumption goods are those things which we use in our daily life, like food or watching movies, all those things. And remember, whatever you do not consume, you save and consume at some point in the future. Now, when I talk about saving, saving is not the act of consuming all of the current income. Whatever is not consumed out of the spendable income, by definition, it is called saved. So saving is an action measured over time, a flow. And savings are a stock and as an accumulation resulting from the act of saving in the past. Now all of you write in the discussion board what is the difference between flow and stock in economics. My next point is to understand the difference between saving and savings, and to know which one is stock and which one is flow. So we have to also distinguish between the stock and flow. A stock is an amount at a given point of time. If you think of the terms like net worth, assets, liabilities, and debts, these are all part of stock. When you talk about flow, it is a time sensitive change. Think of the terms like income, expenses, appreciation, cash flow, etc. It is very important and essential to distinguish between the saving and savings. Saving is an action that occurs at a particular rate, for example, $40 per week or $2,000 per year. The rate is a flow. It is expressed per unit of time, usually a year. Implicitly then, when we talk about saving, we talk about a flow rate of saving. Savings, by contrast, is a stock concept measured at a certain point or instant in time. Your current savings as a result of past saving. You may currently have savings of $8,000 that are a result of 4 years saving at a rate of $2,000 per year. So remember, savings is a stock concept and saving is a flow concept. Consumption is also a flow concept. You consume from after-tax income at a certain rate per week, per month, or per year. Let us now move on to new definitions and relationships. First, we have, discussed about the consumption goods. Consumption goods are those goods which are bought by the household, such as food, movies, all those things. When you talk about, capital goods, it's all the durable producer goods, non-consumption good that farms make to use it for further production. This is all the fixed investment made by the business. Now, as I have already mentioned, $1 of take-home income can be allocated to either consumption or saving. So if we understand this, then we can frame the relationship between the saving, consumption, and disposable income from the following expression. Consumption plus saving is identical to disposable income. So this is called as accounting identity. It means that it has to hold true at every moment in time. And to indicate that relationship is always true, we have used this triple bar symbol. From this relationship, we can derive another definition of saving. That is, saving is identically equal to disposable income minus consumption. Hence, saving is the amount of disposable income that is not spent to purchase on the consumption good. There is another term called as investment. Investment is also a flow concept. Investment as used in economics is always different from finance or other terms. Generally, sometimes students get confused that investment means like you are investing in stock market or real estate, in bonds, all those things. So in general layman term, it means putting your funds into the capital market or stock market or real estate business. But in economics, it is different. The definition is different. Investment is defined to include expenditures on new machines and buildings, like all these capital goods. All these capital goods help us to generate the future stream of income. So this is called as fixed investment. Apart from this, there are changes in business inventories, right? And that are called as inventory investment, which are, the raw materials, all the goods, all the components that are used in the business. Let me now illustrate the determinants of plant consumption and plant savings. In the classical model, the supply of savings was determined by the rate of interest. Specifically, if you can see here in this image, in this graph, higher the rate of interest, the more people wanted to save, and therefore the less people wanted to consume. In contrast, according to Keynes, the interest rate is not the most important determinant of individuals' real saving and consumption, decisions. So in the classical model, they have given priority, they have given importance to rate of interest, which influences the saving and consumption decision. But Keynes have a different view, different, perspective. He argued that the interest rate is not significant factor in saving and consumption decision. Rather, real savings and consumption decision depend primarily on household real disposable income. Furthermore, a person's anticipation about future flow of income influences how much of the current income is allocated to consumption and how much is allocated to saving. So if you are earning some money today and you are assuming that in the future you are going to have a higher amount of income, right, then your priority of saving will be different. The relationship between the planned consumption expenditure of the households and their current level of real disposable income has been called as the consumption function. Now, have a look at the question how income flows can influence consumption and savings. There is a theory called as life cycle theory of consumption, and this theory states that the most realistic and detailed theory of consumption, often called as life cycle theory of consumption, considers how a person varies the savings and consumption as income ebbs and flows throughout the entire life span. This theory predicts that when an individual anticipates a higher income in the future, he or she will tend to consume more and save less in the current period than would have been the case otherwise. And you can see here this diagram, and over here there is different number of years of the person, and then it is showing that whether the person will be saving or not saving. So in the initial, during or before 20s, there may be a student loan for education, and then the income curve is also showing that at highest point of saving will be there when the income is generated between the age of 20 to 65. So at the age of 14 there will be maximum amount of saving. By the age of 65, when there is retirement, your amount of saving have already declined. After 40 it will be declining, and then after 65 there will be dis-saving. To explain how income flows can influence consumption and saving, there is another hypothesis, another theory. Nobel laureate Milton Friedman, one of the most effective advocates of free market and free mind, mentioned this. The permanent income hypothesis suggests that the income level that matters for a person's decision about current consumption and saving is permanent income. So now he is focusing on if any individual is earning income, then whether it is a permanent income or it is temporary income. And all these important decisions of consumption and saving is related to permanent income or expected average lifetime income. Thus, if a person's flow of income temporarily rises without an increase in average lifetime income, the person responds to by saving more and leaving consumption unchanged. So which economist theory or hypothesis you liked better and why? Whether you liked about the life cycle theory of consumption or permanent income hypothesis. Which one you like? Just let me know. All of you now pay attention to the Keynesian theory of consumption and saving. Keynes argued that the real consumption and saving decision depend primarily on households' current disposable income. Okay, and the consumption function is the relationship between the amount consumed, whatever an individual or household they consume on goods and services, and the disposable income. A consumption function indicates how much of the people plan to consume at various levels of the disposable income. It shows how much all the household plan to consume every year or per year at each level of the real disposable income. As the real disposable income rises, planned consumption also rises, but by smaller amount as mentioned by Keynes. Planned savings also increases with disposable income. The planned saving sometimes also becomes negative. If the income drops below that level, then the more the household engages in this saving, either by going into debt or by using up the existing wealth. So when we talk about the consumption function, it is represented by this equation. C, which is the consumption spending, equals to A, which is autonomous consumption, and M is the marginal propensity to consume, plus D is the disposable income. More of this information can be found in this investopedia.com. You can go and check their videos also for additional information. There is a term called as dis-saving. Dis-saving is negative saving, a situation in which your spending exceeds the income. Dis-saving can occur when existing household is able to borrow or use up existing assets. They use the current wealth and maybe go for any kind of debt. And this is a diagram which is showing, again, based on which time you are borrowing, which time you are saving, and there is dis-saving. So during the time of college education, there is more of borrowing. During the primary working years, there is more of savings. And during the time of retirement, there is more of dis-saving. Have a look at this figure, the consumption and saving function, and it shows the relationship between the two concepts. In the upper part of the figure, the vertical axis measures the level of planned real consumption per year. The horizontal axis measures the level of real disposable income per year. In lower part of the figure, the horizontal axis is the real disposable income per year, but the vertical axis is the planned real savings per year. All of these are on dollar per year basis, which emphasizes the point that we are measuring, the concepts about flows, not stock. As you can see here, we have taken the income consumption and income saving combinations A through K and plotted them. In the upper part, the result is called as consumption function. In the lower part, the result is called as saving functions. Mathematically, the saving function is the complement of the consumption function because consumption plus saving always equals to disposable income. What is not consumed by definition is saved. The difference between the actual disposable income and the planned rate of consumption per year must be the planned rate of saving per year. How can we find the rate of saving or dissaving in the upper part of the figure? For that, we begin by drawing a line which is equidistant from the horizontal and vertical axis. This line is the 45 degree from either axis and is often called as the 45 degree of reference line. At every point on the 45 degree reference line, a vertical line drawn to the income axis is the same distance from the horizontal line drawn to the consumption axis. Thus, at point F, where the consumption function intersects the 45 degree line, the real disposable income equals the planned real consumption. Point F is sometimes called as the break-even income point because neither positive nor negative real savings are there. And this can be seen in the lower part of the figure as well as in the above part of the figure. The planned annual rate of real saving at a real disposable income of $60,000 is indeed zero. If you have a look to the left of the point F, either part of the figure, the hypothetical family engages in dissaving either by going into debt or by consuming the existing assets. If you have any questions relating to this diagram, please write your questions in the Google Doc that I have shared with you. We'll continue this discussion on the determinants of planned consumption and planned saving by focusing on autonomous consumption. What is autonomous consumption? It is the part of consumption that is independent of the level of disposable income. Changes in the autonomous consumption shift the consumption function. It is the consumption expenditure that occurs when income level is zero. Such consumption function is considered autonomous of income only when the expenditure on these consumables does not vary with the changes in income. Necessarily, it may be required for fund necessities or debt obligations. You may have rent or mortgage payments that you have to pay. Maybe you'll go for debt from bank or other financial institutions. Now look at the point on the diagram where the real disposable income is zero, but the planned consumption is $12,000. The amount of real planned consumption which does not depend at all on the actual real disposable income is called as autonomous consumption. The autonomous consumption of $12,000 is independent of the disposable income. And what it means? It means that no matter how low the level of real income in this hypothetical household falls, the household will always attempt to consume at least $12,000 per year. Assuming the household real disposable income does not equal to zero year in and year out. There is certainly a limit to how long this hypothetical household could finance the autonomous consumption without income. That $12,000 of yearly consumption is determined by things other than the level of income. And here we do not specify what determines the autonomous consumption, but we are just trying to explain that it is $12,000 per year. Maybe that family have to pay for food, medicines, educations, house, which is $12,000 per year. So just remember the word autonomous means existing independently. And in our model, autonomous consumption exists independently of the hypothetical household level of real disposable income. And there are many possible types of autonomous expenditure. Here we are assuming investment is autonomous or independent of income, and we are assuming that the government expenditure are autonomous, just to simplify this income determination model. Can you answer me, why does taking into account the consumer sentiment improve policymaker forecast of household future consumption expenditure? As you can see here, there are two more concepts called as average propensity to save and average propensity to consume, which is represented by APS and APC. The formula to calculate the average propensity to save is real saving divided by the real disposable income. Average propensity to consume can be found out by the real consumption divided by the real disposable income. For any given level of real income, the proportion of the total real disposable income, that is to saved, is called as average propensity to save. For any given level of real income, the proportion of the total real disposable income that is consumed is average propensity to consume. The average propensity to consume decreases as the real disposable income increases. And this decrease simply means that the fraction of households' real disposable income going to consumption falls as the income rises. The average propensity to save, if you go back to your book and check the table number 12, you can see that the average propensity to save, which is first negative, finally hits zero at income level of $60,000 and then becomes positive. So it's very easy to figure out your own average propensity to consume or save. Just what you have to do, divide the value of what you consumed by your total disposable income for the year, and the result will be the personal APC at your current level of income. Also, divide your real saving during the year by your real disposable income to calculate your average propensity to save. So, in the DQ, can you write down your own personal average propensity to save and average propensity to consume? Pay attention to these two concepts, marginal propensity to consume and marginal propensity to save. The formula to find out the marginal propensity to consume is change in real consumption divided by change in real disposable income. I have told you several times in the previous lectures that whenever the concept of marginal will be discussed, always remember it means some change. So what is the change in the real consumption, and what is the divided by what is the change in the real disposable income will give you the value of marginal propensity to consume. Marginal propensity to consume is the increase in the consumer spending due to increase in the income, and that increase actually represents the change. So it is the ratio of change in the real consumption due to the change in the disposable income. because when disposable income changes, people consumption pattern will change. Remember, the marginal propensity to consume values always range from 0 to 1. If a person's entire increase in income is consumed, then the change in consumption will be equal to the change in income, making the MPC equals to 1. The triangular shape that you can see here represents change. So whenever you are going to write any formula, you can use this triangular symbol to represent change. In case that the entire income is saved, change in consumption is 0, which means that the marginal propensity to consume is 0, because you have saved all your income and you have not purchased anything, you have not spent anything. So therefore the marginal propensity to consume have become 0. The marginal propensity to save can be found out by dividing the change in the real saving with the change in the real disposable income. Now you can see here, for both the concept, the denominator is the change in the real disposable income. And if you are talking about marginal propensity to save, then we are considering the change in real saving as the numerator. If you are considering the marginal propensity to consume, then we are talking about the change in the real consumption. Marginal propensity to save refers to the proportion of any extra income that is saved by the consumer. The ratio of change in saving to change in disposable income is what is called as marginal propensity to save. And always remember, the marginal propensity to save is related to marginal propensity to consume. So if you ignore the taxes and imports, right, then the marginal propensity to save can be found out by this formula, that is 1 minus marginal propensity to consume. If you have any questions relating to these two concepts, please write your questions on the Google document that I have shared with you. Write down in your discussion board your thoughts on what do the marginal propensity to consume and marginal propensity to save tell us. And also, can you tell me, when the MPC is equal to 0.75, what is the value of MPS?
Let us understand the relationship between the consumption, saving, and real disposable income with an example. And we can study the relationship using various ratios also. In the example, there are certain data that has been provided. The real disposable income is 54,000. Real consumption is about $49,200 and saving is around $4,800. Later, the income increased by $6,000 from 54,000 to 60,000. The consumption increased by 4,800 from 49,200 to 54,000. Savings increased by 1,200 from $4,800 to $6,000. Using this information, we are trying to find out the value of the APC, APS, MPC, and MPS. The first one is average propensity to consume, and for finding out this average propensity to consume, we have to calculate the ratio between the real consumption divided by the real disposable income, which is 49,200 divided by 54,000, that gives 0.91. Average propensity to save is the ratio between the real saving divided by the real disposable income, which is $4,800 divided by 54,000, and that gives you 0.09. To find out the marginal propensity to consume, we have to see what is the change in real consumption, by what amount the real consumption have changed, and by what amount the real disposable income have changed. And that is 4,800 divided by 6,000, which is 0.08. Marginal propensity to save is the ratio between the change in the real saving divided by the change in the real disposable income, which is $1,200 divided by $6,000, which is 0.02. Now, if you just observe all these, results that we have found out, we can, form a relationship which is the average propensity to consume plus average propensity to save is identically equal to 1, and the marginal propensity to consume and marginal propensity to save is identically equal to 1. Just if we add 0.08 plus 0.02, it's 1, and here also 0.09 and 0.91, it's 1. So that is the relationship between the marginal propensity to consume with marginal propensity to save, average propensity to consume with average propensity to save. If you have any questions relating to the calculations of these 4 components, just feel free to ask me in the Google Doc that I have provided. Let me now discuss about the causes of the shift in the consumption function. A change in any other economic variables apart from the real disposable income can cause the consumption function to shift. Well, there are a lot of variables, lot of factors can, lead to shift in the consumption function. Either the consumption function will lead to move upward or shift upward, or it can shift downward. One of the important determinant is the net wealth, which affects the position of the consumption function, or which shifts the consumption function. If there is any increase in the net wealth of the average household, it will lead to the consumption function to shift upward. The movement will be in upward direction. If there is decrease in the real net wealth, then it will cause the consumption function to shift downward. So net wealth means the stock of assets which are owned by the person, household, firm, nation. And for the household, wealth can consist of house, car, personal belongings, stock, bonds, bank account, cash, minus any kind of debt owned, because debt is a liability. Now, I have a question: why the US economic saving rate rises during the recession? During the period of 2007 to 2009 recession, the saving rate or the average propensity to save increased from 3% to 6%. As per the Keynesian theory, the average propensity to save declines as the disposable income increases. Average propensity to save rises as the disposable income decreases. And that is one of the explanation for this question. So far, we have been talking about the consumption function of an individual or a household. Now we'll move to the discussion based on the national economy. Have you ever, know the story of Robin Hood? Some people think that If government acted like Robin Hood, the economy would work better. But in fact, changing the distribution of wealth would not accomplish this. Certainly, redistributing wealth from high-income households to lower-income households would cause the autonomous consumption of lower-income households to rise. But such a redistribution of wealth could cause the autonomous consumption of high-income households to fall. On net, the total household wealth would be unaffected by redistribution. Thus, the aggregate autonomous consumption would almost be unchanged and the aggregate consumption function would not move upward. You can read more about the government acting as Robin Hood from this article source at feed.org. And just let me know in the DQ whether you agree or disagree with this statement that if government acted like Robin Hood, the economy would work better.
You can take a break for a few minutes before, going for the next few more topics on this chapter.
Apart from consumption, in the prior slides, I have discussed about investment. Now, if you remember, investment consists of expenditures on building and equipment and any changes in business inventories. Do you remember what the investment in economics is not all about? It is not about the stock and bonds. So anything that helps to create more of goods and services is a part of investment in economics. Historically, the real gross private domestic investment in United States has extremely been volatile over the years relative to the real consumption. So if you were to look at the net domestic investment or investment after depreciation has been deducted, we would see that the depth of Great Depression and at the peak of World War II effort, the figure was negative. In other words, we are eating out our capital stock. We are not maintaining it by fully replacing the depreciated equipment. If you compare the real investment expenditure historically with the real consumption expenditure, we can find that the latter are less variable over time than the former. Why is so? One of the possible reasons is that the real investment decision of the businesses are highly variable and subjective estimate of how economic future looks like. If you have any questions, feel free to ask on this. Consider all the times businesses perceive an array of investment opportunities. These investment opportunities have rate of interest which ranges from 0 to a very high number. If the return is high, if the rate of return rises, the number or the dollar value of all such projects increases, and that is very attractive for the business. A project is profitable only if its rate of return is greater than the opportunity cost of investment, that is the rate of interest. So if the rate of interest is decreasing, the planned investment spending will increase, because with decrease in the interest rate, business have more of borrowing, capacity. The borrowing cost reduces because they can borrow funds from, banks or financial institutions at a lower cost, and that cost is the interest rate. When the planned investment is increasing, more investment opportunities will be profitable and vice versa. Again, it depends on whatever method of financing you are choosing. Even if the firm uses retained earning or the internal financing to fund the investment, the lower market rate of interest, the smaller is the opportunity cost of using those retained earning. Do you remember what do you mean by retained earning and what do you mean by opportunity cost? Retained earning is the portion of profit that is, kept and not distributed as dividend by the business. Thus, it doesn't matter in our analysis whether the firm must seek financing from external sources or can obtain this financing by using the retained earning. So the investment function is represented as an inverse relationship or indirect relationship between the rate of interest and the value of planned real investment. You can see here in this table as the annual rate of interest is declining, the planned real investment per year is increasing. So they have an inverse relationship, indirect relationship, and these two variables move in opposite directions. As mentioned in the previous slide, the relationship between the annual rate of interest and the planned real investment, they have an inverse relationship. Therefore, here in this figure, you can see the data which they have for the annual rate of interest and the planned real investment, and it is showing you a negatively, sloped curve because of the inverse relationship. The next question is, what causes the investment function to shift? Because planned real investment is assumed to be the function of rate of interest, any kind of non-interest rate variable that changes have a potential of shifting the investment function. And one of those variables is the expectation of businesses. If higher profits are expected, more machines and bigger plants will be planned for the future. More investment will be undertaken because of the expectation of the higher profit. The businessmen, if they expect that they can generate a higher rate of return, they will be motivated to make more investment in different technology, plants, building, so that they can have more and more of production activities for generating higher amount of profit, and that will lead to shift the curve to the right, meaning that the more investment would be desired at all the rate of interest. The second variable is change in productive technology. Any change in the productive technology can potentially shift the investment function. A positive change in the productive technology will stimulate the demand for additional capital good and shift the investment function outward to the right. The third factor is changes in the business taxes, which can shift the investment schedule. If they increase, we predict a leftward shift in the planned investment function because higher taxes imply a lower after-tax rate of return. So remember, these are the three important variables in the investment function which can shift the investment function to either left or to the right or to the outward. Now I'm interested to share about the determination of equilibrium real GDP per year. If you remember that consumption function that we have discussed earlier. It related the planned real consumption expenditure to the level of real disposable income per year. And we have already shown where adjustment must be made to GDP in order to get the real disposable income. The real disposable income actually turned out to be less than the real GDP because of the net taxes, or any kind of government transfer payments that has been made. A representative average is about like 18%. So the disposable income on average has been in the recent year around like 82% of the GDP. Now we can also focus on the consumption as a function of the real GDP. And to simplify our model, we'll assume that the real disposable income, which is different from the real GDP by the same absolute amount every year. Therefore, we can relatively or easily substitute the real GDP for the real disposable income in the consumption function. We can now plot any of the consumption function in a diagram, which is the horizontal axis is no longer the real disposable income but rather the real GDP, which I have mentioned over here as real GDP per year in trillions. Now, you can notice that there is an autonomous part of the real consumption that is, also being labeled over in this figure. Now, let us assume the MPC out of the real GDP equals 0.8, suggesting that 20% of changes in the real disposable income is saved. 80% is consumed and 20% is saved. In other words, additional after tax $100 is earned, so additional $80 will be consumed. Now in this figure you can also see a 45-degree reference line. And what is that? How we can have interconnection with this figure. Along with the 45-degree reference line, the planned real consumption expenditure C equals the real GDP per year, that is Y. So at any point where the consumption function intersects the 45-degree reference line, it will be exactly equal to the real GDP per year. And the consumption curve intersects the 45-degree reference line at a value of 1 trillion per year in the base year dollars. That is the value of current GDP expressed in prices in the base year. If we want to add the investment function, what we can do, along with the consumption, like AD is the aggregate demand, which we have discussed in the previous chapter, that it is the function of consumption, investment, government expenditure, and net foreign transactions or exports and imports. So another component of aggregate demand is of course the real investment spending apart from the consumption function. So the planned investment function, which related real investment, include the changes in the inventories of the final product to the rate of interest. In these three figures, we have combined the consumption and investment. In panel A, it is found that at the interest rate of, this is the vertical line is the interest rate and the horizontal line is the real investment per year. So at an interest rate of 5%, the real investment equals to 2 trillion per year. In panel B, the investment is a constant 2 trillion per year. When we add this amount to the consumption line, we obtain in panel C the C plus 1, which is equal to Y, which is vertically higher than the C line by exactly 2 trillion. So real GDP equals to consumption plus investment at the 11 trillion per year, where the total planned real expenditure, that is C plus I, equal to the actual real GDP for this, is where the C plus I intersects as the 45-degree reference line on which the C plus I equal to Y at every point. So just for simplicity, what we can do, we can just ignore the dependence on saving on the income, which can influence the investment. This slide shows an example about the diminished rightward shift in the Germany's investment function. Germany's real investment expenditures as a share of real GDP has been highest in Europe, but in recent years, the speed at which its investment function has been shifting rightward has slowed. So today, Germany is no longer Europe's investment engine. In this slide, I'll show you a figure explaining the planned and actual rate of saving and investment. This figure shows the planned investment curve as the horizontal line at 2 trillion per year in the base year dollars. Real investment is completely autonomous in this simplified model, and it doesn't depend on the real GDP. And you can also see here in this figure that there is planned saving curve, and it is represented by S. Because in our model, whatever is not consumed by definition is saved. So the planned saving schedule is the complement of the planned consumption schedule, which is represented by the C line. For better exposure, you can also look at the part of saving and investment schedules, the annual level of the real GDP between the 9 trillion to 13 trillion dollars. The question is, why does the equilibrium have to occur at the intersection of planned saving and planned investment schedule? If we are at E in this figure, the planned saving equals the planned investment. Can you see that? Any questions so far on this? So here, if we are at E, the planned saving equals the planned investment, and all the anticipations are validated by reality. And there is no tendency for the business to alter the rate of production or the level of employment, because they are neither increasing nor decreasing their inventories in an unplanned way. Just to summarize, only at the equilibrium, the real GDP will be the planned saving versus actual saving. Planned investment equals the actual investment, and therefore the planned saving equals the planned investment. Let us now have a observation on the two situations when there is unplanned increase in the business inventories and when there is unplanned decrease in the business inventories. If you remember, inventories are of three types: raw material, work in process, and finished goods. Okay, all the product that have been, finally being sold. So suppose there is unplanned increase in the business inventories. Let us see what will be the situation. Now, consumer purchases fewer goods than the anticipated, right? So less of goods are being sold than the inventory that the farm have, right? So that leaves the farm with unsold product and inventories. It will accumulate, or it will increase the amount of inventories which cannot be, sold in the market. Now businesses respond to this in two different ways, because they have now some, inventories. They don't want to again start the production. They will cut back production. They'll reduce the production activities. When the production activities will be reduced, obviously they will need less labor, and that will reduce the employment opportunities because they don't want to pay for the wages. When there is unplanned decreases in the business inventories. So in that case, what the business as a strategy they will do, they will increase the production of goods and services, and that will generate higher amount of income. Ultimately, it will increase in the real GDP because there are a lot of production activities, a lot of job opportunities, and that will lead to real GDP rise.
There are a lot of information in this chapter so far. So would you like me to explain anything further, or do you need any more explanations on this? Please write your questions on the Google Doc so that I can help you to understand the topic better. For now, you can take a break. Just think of what you have already learned. Maybe in your mind, just think of all the graphs or theories or the model that you have analyzed so far, and you can take note. Let me now focus on the fourth objective, Keynesian's equilibrium with the government and the foreign sector being added. So far, we have not taken into account the role of government in the model or the foreign sector. We have only taken into account consumption and investment. Now, let us see what happens when we take into account these two important elements, that is government and the foreign sector of the economy. To add the real government spending, which can be represented as G, to our macroeconomic model, we have to take into account certain assumptions. And what are these assumptions? The level of resource using government purchases of goods and services at federal level, state level, and local level, not including the transfer of payments, is determined by the political process. In other words, we can say G will be considered as autonomous, just like the real investment. In United States, resource using the federal government expenditure account for approximately 25% of the real GDP. On the other side of the coin, there are real taxes which are used to pay for the government spending. Government collect taxes and spend in various activities like maybe on national defense, on various kind of transport payments, or any kind of public transportation or other amenities. So we'll simplify our model greatly by the assumptions that there is a constant lump sum of 2.3 trillion tax a year to finance the 2.3 trillion of government spending. So lump sum tax is a tax that doesn't depend on income. For example, $1,000 tax that every household must pay irrespective of economic situation. The lump sum tax will reduce the disposable income by same amount. The next factor or the next determinant is the foreign sector. For years, we have, news on this foreign trade deficit. we have been buying merchandise and services from the foreign residents, the real imports, the value of which exceeds the value of real exports, which we have been selling to them. The difference between the real exports and real imports is the real net exports, which can be labeled as X in our graph for explanation. The label of real export depend on the international economic conditions and especially in the countries that buy our products. Real import also depend on economic condition at home, or the home country. So for the simplicity, we'll assume that the real imports exceeds the real exports. That is, the real net export X is negative, and therefore the label of real net export is autonomous, that is independent of the real national income. So let us assume a label of X of 0.8 trillion per year in the graph. So when we are considering the model, we have to also take into account the government and the foreign sector, and that leads to C plus I plus G plus X. Here is a table that shows the determination of equilibrium real GDP with government and net exports being added. In the first column, there is data about the real GDP. The second column about the real taxes, which is assumed the same throughout. The real disposable income data is given. Then there is planned real consumption, planned real saving, planned real investment, right? All the important component that we have discussed earlier: consumption, saving, investment, real government spending, and the real exports, which is your export minus import, that is your foreign sector. Total planned expenditure data is provided, and unplanned inventory changes, whether there is increase in the inventory or decrease in the inventory for the business, and the direction of change in the real GDP. With all this data being provided, there has been, different results that has been given about whether there is increase or decrease in the GDP. For determining the equilibrium level of GDP per year, here I have provided a figure, and we are now in a position to determine the equilibrium level of real GDP. But here we have to remember that equilibrium always occurs when the total planned real expenditure equals the real GDP. The consumption function with no government and no taxes is shown as C. When we add autonomous investment, government spending, net exports, we obtain the model as C plus I plus G plus X. We move from E1 to E2, and the equilibrium real GDP is approximately 18 trillion per year. So if you have any questions relating to this determination of equilibrium level of GDP, please post your question on the Google Doc that I have shared. Let us now just summarize few of the observations relating to the equilibrium level of real GDP. If C plus I plus G plus X equals Y, then there is equilibrium GDP. if C plus Y plus G plus X is greater than Y, then there is unplanned decrease in inventories and business raises output, Y returns to equilibrium. If C plus I plus G plus X is smaller than Y, then there is unplanned increase in inventories. So what the business do? They just reduce the output and Y returns to the equilibrium. So always the objective is how Y will reach towards the equilibrium point. Now, what if the real income earned by the resident of other nations were to increase? In that case, the foreign resident would increase their purchases of the US produced goods and services because they will now prefer those products, and more US exports would cause the model, the C plus I plus G plus X curve to slope upward. At the initial equilibrium, the real GDP level, total planned real expenditure, is greater than the real GDP, leading to a decrease in inventories. Farm production and thus the equilibrium level of US real GDP would increase. In economics, the concept multiplier refers to an economic factor that when increased or changes causes increase or changes in other economic factor or the related economic variables. The ratio of change in the equilibrium level of real national income to the change in autonomous expenditure can be explained here as multiplier. It is the number by which a change in the autonomous real investment or autonomous real consumption is multiplied to get the change in the equilibrium real GDP. Any permanent increase in autonomous real investment or in autonomous component of the consumption will cause a larger increase in the real GDP. Any permanent decrease in the autonomous real spending will even cause larger decreases in the real GDP per year. Now, in order to understand why multiple expansion or contraction in the equilibrium real GDP occurs, we can take into account a simple multiplier formula with a question that how can 100 billion increase in investment generate 500 billion increase in the equilibrium real GDP, and that happens through the multiplier process. And for that, the formula that has been used is here: 1 divided by 1 minus marginal propensity to consume. As we already knew earlier that 1 minus marginal propensity to consume is marginal propensity to save. So multiplier is also equals to 1 divided by MPS or marginal propensity to save. All of you should focus your attention in this slide. It is little tricky one. We are going to discuss about the multiplier, the expenditure and the aggregate demand. So before we focus on all this data relating to the multiplier process, let me give you a brief information about measuring the change in the equilibrium income from a change in the autonomous spending. So change in equilibrium real GDP equals multiplier multiplied with the change in autonomous spending. One of the important property of the multiplier is that the smaller the marginal propensity to save, the larger is the multiplier. The larger is the marginal propensity to consume, the larger is the multiplier. And the significance of multiplier is that a relative small change in the consumption or investment can trigger a much higher or larger change in the real GDP. So let us focus our attention on this table on the multiplier process. So here we have different information, and before we beginning on the data, we are assuming that the marginal propensity to consume will be equal to 0.8 or 4 by 5 ratio, and the marginal propensity to save will equal 0.2 or 1 by 5. Now let us run an experiment and say that a particular business, all the businesses, they decide to increase their real investment permanently by $100 billion a year. So we are assuming the businesses will increase their investment by $100 billion a year. So investment can be in the machines, furniture, equipment, all capital stock and everything. So when we are assuming that there is $100 billion a year of investment, the data is provided over here. So every time 100 billion per year will be I, that is your investment, and I have provided here dots for number of like years. So in the first column, the investment increased by the $100 billion, and this means that an increase in the real GDP of 100 billion, because the spending by one group represents the income for other, right? So when you are investing, you are spending on various goods, it is obviously income for those who are providing those capital goods, right? So because of this increase in the real GDP of 100 billion, there is spending by one group which is income from another, and that is represented by column 2, which is annual increase in the real GDP. Column 3 gives the resultant increase in consumption by the households, because that received additional 100 billion in income, and this is found by multiplying the marginal propensity to consume by the increase in the real GDP. Because the marginal propensity to consume is 0.8, so therefore in column 3, when you multiply 100 with 0.8, it gives 80. When you multiply 80 with 0.8, it gives $64 billion. When we multiply 64 again with 0.8, then it is 51, because this marginal propensity to consume is based on um, this ratio 0.8 or 4 by 5 that is calculated on the real GDP. So because marginal propensity to consume equals 0.8, real consumption expenditure during the first round will be increasing by 80 billion. But that is not the end of the story. This additional household consumption is also spending, and it will provide around 80 billion of additional income for other individuals. Thus, during the second round, we can see there is an increase in the real GDP of 80 billion. Now, out of this increased real GDP, what will be the resultant increase in the consumption expenditure? As I have already mentioned, it will be 0.8 times of 80 billion, which is $64 billion. So we'll continue these induced expenditure rounds and find out an initial increase in the autonomous investment expenditure of 100 billion will eventually cause the equilibrium level of real GDP to increase by 500 billion. So at the end, you can see annual increase in the real GDP totals around $500 billion. In other words, the equilibrium real GDP will change by an amount equals to the 5 times the change in real investment. When you talk about the multiplier formula, it turns out that the autonomous spending multiplier is equal to 1 divided by the marginal propensity to save. So in our example, the marginal propensity to consume was 0.8 or 4 divided by 5. Therefore, because MPC plus MPS equals 1, because that is the relationship that we have discussed earlier, the MPS was equal to 0.2 or 1 by 5 ratio. So when we divide 1 by 1 by 5, we get 5, and that is our multiplier. So as I've shown here below this table, you can see the multiplier equals to 1 divided by 1 by 5, that is the 5. $100 billion increase in the real plant investment led to 500 billion increase in the equilibrium level of the real GDP. Our multiplier will always be 1 divided by MPS. You can now figure out the multiplier if you know either the MPS or MPC. And it will always be equal to 1. So for example, here also 3 divided by 5 is the MPC. So MPS will be 2 by 5, and that makes 2 1. And the multiplier will be 1 divided by 2 divided by 5, that is 2.5. Now from this example, you can understand that the smaller the marginal propensity to save, which is here in this case, the larger is the multiplier. So 1 by 5 is the marginal propensity to save, and the multiplier is 5. 2 by 5 is the marginal propensity to save, 2.5 is the multiplier. Otherwise stated, larger the marginal propensity to consume, larger is the multiplier, which is 4 by 5. The multiplier is 5. Marginal propensity to consume is 3 by 5, and multiplier is 2.5. So all these you can demonstrate yourself by computing the multiplier when the marginal propensity to save equals 3 by 4 or 1 by 2 and 1 by 4. If you have any questions on this, just write that on the Google Doc that I've shared with you. Can you focus on how a change in the real autonomous spending affect the real GDP when the price level can change? So far our examination was how changes in the real autonomous spending affect the equilibrium real GDP, has considered a situation in which the price level remains unchanged. Hence our equilibrium analysis has only considered how much aggregate demand shift in response to investment, government spending, net exports or lump sum taxes. When you take into account the aggregate supply curve, we must consider the responses on the equilibrium price level to a multiplier induced change in the AD. Here, $100 billion increase in the autonomous spending, investment, government or net exports moves the AD1 to AD2. If the price index increases from 110 to 115, the equilibrium real GDP goes up, only to say 18.3 trillion per year instead of 18.5 trillion per year. Remember, autonomous spending will be relatively small because most of the changes will be in the price level. Moreover, any increase in the short run equilibrium level of the real GDP will tend to be temporary because the economy is temporarily above the long run aggregate supply. The strains on its productive capacity will raise the price level. Moving on, we'll discuss about the relationship between aggregate demand and C plus I plus G plus X curve. There is clearly a relationship between the aggregate demand curve and consumption plus investment plus government expenditure plus net foreign exports curve, which is developed in this chapter. Because after all, we have discussed that aggregate demand, it always consists of four important components, that is consumption, investment, government spending or government expenditure, and foreign sector of our economy. There is a major difference, however, between the aggregate demand curve, that is AD, and C plus I plus G plus X curve. The latter is drawn with the price level held constant, where the former is drawn by the definition with the price level being changing. To derive the aggregate demand curve from the C plus I plus G plus X curve, we must now allow the price level to change. Now, the question is, what are some of the effects of the price level increase? And that effect of price level increase can be explained by the three important factors which we have discussed earlier, that is the real balance effect, interest rate effect, and the open economy effect. This figure shows the relationship between the aggregate demand and the C plus I plus G plus X curve. In the upper figure or upper graph, the C plus I plus G plus X curve is at a price level which is equal to 100, intersects the 45-degree reference line at E1 or 18 trillion of the real GDP per year, and that gives us a point A where the price level equals 100 and the real GDP equals 18 trillion in the lower graph. When the price level increases to 125, the C plus G plus I plus X curve shifts downward, and the new level of the real GDP at which the planned real expenditures equal the real GDP is at E2 at $16 trillion per year. This gives us a point B in the lower graph. Connecting both point A and B, we can obtain the aggregate demand curve. Do you have any questions on this? This is the last slide for this lecture. It is issues and application, and investment spending slowdown holds down the US real GDP. According to the Keynesian theory, an economic recovery usually occurs when businesses' profit expectation improve and the investment function shifts rightward. In the absence of significant improvement in the business's profit expectation, the investment function has failed to shift rightward in order to create a multiplier effect that would have produced a full recovery in the equilibrium real GDP from the previous recession. And this is a figure which is just showing the average ratio of investment spending to firms' profit flows by decade since 1980.